world didn't expect it. One quiet trade dispute in early 2025 suddenly ignited into a full-blown geopolitical showdown. And at the center of it all wasn't oil, semiconductors, or steel. It was gold. The United States, in a move that rattled markets from New York to Zurich, slapped a shocking 39% tariff on Swiss gold bars, targeting the very 1 kilogram and 1 ounce standards that central banks and global traders depend on. In an instant, gold futures exploded to an all-time high of $3,534 per ounce, breaking records and shaking the foundations of global finance. What looked at first like another battle in Trump's never-ending tariff wars quickly escalated into something much bigger. This wasn't just about bullion anymore. It was about power, leverage, and the credibility of entire financial systems. Switzerland, which refines about 70% of the world's gold and shipped over $36 billion worth of bullion to the United States in the first quarter alone, suddenly found itself thrust into the spotlight. And as events unfolded, traders, politicians, and central bankers realized that this confrontation could reshape reserves, trade flows, and even the momentum of global monetary policy for years to come. To understand how we got here, we have to rewind. In April 2025, the Trump administration unveiled one of the steepest tariff plans ever imposed on a developed nation. A sweeping 39% levy hit a range of Swiss exports, part of Washington's ongoing effort to narrow America's $48 billion deficit with Switzerland. At the time, most assumed gold would be spared. After all, bullion isn't just another product. It plays a central role in financial stability, reserve management, and liquidity buffers for the Federal Reserve. But Washington's trade hawks spotted an opportunity. By targeting Swiss bullion, they could test just how much leverage the United States had over the world's biggest gold refiner, and whether Switzerland's dominance in this market was truly unshakable. The gamble didn't stay theoretical for long. On July 31st, U.S. Customs dropped the hammer, ruling that 1 kilogram and 1 ounce gold bars, the standard units traded on COMEX and held by central banks, would be subject to the full 39% tariff. Panic rippled through financial markets. Gold futures shot upward, hitting that record $3,534 per ounce. Traders scrambled to hedge. Central banks reconsidered their reserve positions. And Swiss President Karin Keller-Sutter rushed to Washington in a desperate last-minute attempt to appeal the ruling. But her pleas fell on deaf ears. The tariff stood, and global finance braced itself for the consequences. Then came the twist. Just as markets adjusted to the new reality, Trump took to social media and stunned the world. In a post that spread faster than any official press release, he declared that gold bars would, in fact, be exempt from tariffs. The sudden U-turn sent futures tumbling back to about $3,407 an ounce, leaving investors dizzy. For some, this was evidence of Trump's unpredictable negotiating style. Hardball one day, reversal the next. For others, it was a sign of how chaotic and fragile global trade policy had become under the weight of tariffs and countermeasures. But behind the headlines, the real story is Switzerland's unique role in the gold ecosystem. Refining gold is not a simple matter of melting metal. It is an industrial art that requires precision, consistency, and certification at the highest levels. Switzerland's 4 major refineries have mastered this process. They produce bars so pure and uniform that they meet the strictest standards for central bank reserves and London Bullion Market Association certification. Canada and Australia have refining industries, but they cannot match Switzerland's sheer capacity or its reputation for reliability. Japan's refiners are tied up meeting domestic demand and face logistical challenges when it comes to scaling exports. That leaves Switzerland as the engine of the system, replaceable in theory, but in practice, almost impossible to substitute without major disruptions. This dominance is why Washington's tariff move shook markets so severely, and why Byrne immediately recognized it as a challenge, not just to its economy, but to its position in global trade. Gold's influence over the American financial system magnified the shock. A tariff that, on paper, might have raised only $1 billion or $2 billion in extra revenue became a force multiplier. Every movement in the gold price directly impacts the Fed's liquidity strategies, bond yields, and the dollar index. A simple $15 rise in premiums can add 15 to 20 basis points to yields. That may sound minor, but it's enough to move currency flows, shake confidence in treasury auctions, and shift the cost of borrowing for governments and corporations alike. Ironically, a tariff designed to reduce deficits risked undermining export competitiveness, strengthening the dollar in ways that hurt American industry and creating new holes in the very fiscal policy it was supposed to defend. Inside the U.S., the gold fight quickly drew out competing political and economic interests. Mining groups in states like Utah pushed hard for stricter transparency and origin rules, hoping that limits on Swiss bullion would create space for domestic production. On the other side, jewelers in Illinois and New Jersey warned that rising prices would crush margins and drive up costs for consumers. Even within Congress, opinions were split. A handful of swing votes in the Senate had the power to reshape the policy altogether. What had started as a clean tariff fight soon became a domestic political brawl layered with competing regional and industry agendas. Meanwhile, Switzerland wasn't sitting still. Recognizing that its strength went beyond gold, Bern expanded the fight. Negotiators began linking gold tariff relief to concessions on pharmaceuticals, luxury watches, and high-value industrial exports, making clear that this wasn't a single-issue standoff. If the U.S. wanted cheaper access to Swiss bullion, it would have to compromise on other fronts. But one issue was absolutely untouchable: banking secrecy. Enshrined in Swiss law and supported by its citizens, financial privacy remained non-negotiable, no matter the size of the concessions dangled on the other side of the table. That position hardened Switzerland's stance, signaling to Washington that Bern had no intention of rolling over. The political debate inside Switzerland mirrored the intensity of the talks. Conservatives argued tariff revenues should be used to protect industry, while progressives pushed to divert funds into climate initiatives and social programs. Yet both sides agreed on one principle: the United States would not get exemptions without meaningful concessions. That rare unity gave Switzerland leverage, amplified by its refining dominance. With over two-thirds of the world's bullion passing through its facilities, any disruption to Swiss supply would ripple through industries from jewelry to electronics, and even to high-tech manufacturing, creating global headaches. Bern knew it held a card that could not easily be beaten. For Washington, the risks of prolonging the standoff grew with each passing day. Higher bullion premiums meant higher borrowing costs, steeper treasury yields, and the potential erosion of confidence in U.S. reserves. For Switzerland, losing access to the U.S. market threatened a painful drop in revenues and forced a re-evaluation of its export balance. Neither side could afford a long stalemate. That's why compromise proposals began circulating. One idea focused on partial transparency. The U.S. would relax its origin certification demands, while Switzerland provided limited, carefully controlled access to financial data. Advocates claimed this could reduce the U.S. deficit by $4 to $5 billion, ease premiums, and buy both governments breathing room. But even this supposed solution carried long-term costs. Additional compliance, insurance, and logistical hurdles would leave a permanent premium on bullion, ensuring markets paid more for gold well into the future. The deeper question that emerged was whether Switzerland's prized independence had become a liability in the modern era of aggressive bilateralism. For decades, its neutrality and banking secrecy had shielded it, allowing the country to carve out a unique place in the global system. Now, those very qualities were being tested. With tariffs, ultimatums, and sudden reversals, the United States had made it clear: no commodity, not even gold, was off the table in its trade wars. And that realization set alarm bells ringing not only in Bern but in financial capitals across the globe. By August, the standoff had become the focal point of global markets. Every rumor from Washington or Bern triggered volatility. Every whisper of compromise moved gold prices by dollars in minutes. Central banks, investors, and hedge funds adjusted their strategies in real time. The entire system was now hanging on a delicate balance between two countries: one, the world's largest economy; the other, the world's gold refinery powerhouse. And the longer the fight dragged on, the more uncertain the outcome became. The verdict is stark. What began as a narrow tariff dispute has evolved into a global test of credibility and discipline. Trump's 39% tariff on Swiss gold bars placed America's fiscal and trade policies under a microscope and forced Switzerland to defend its position at the heart of global bullion flows. Three roads remain. Washington could ease its demands, compromise on origin rules, and secure cheaper gold. It could stay firm, absorb the costs, and risk instability in bond markets and reserves. Or it could gamble on alternatives, redirecting supply chains toward other refiners, or even experimenting with reserve diversification into other metals. Each option carries steep risks, each one a gamble with long-term consequences. The path chosen will shape bond yields, currency flows, and global perceptions of American financial strength for years to come. So, what does this showdown tell us? It tells us that in today's world, no commodity is safe from politics, not even the one that has been a symbol of value for thousands of years. It tells us that leverage is shifting in ways few anticipated, with a small European nation able to stand toe-to-toe with the world's largest economy because of its control over a vital choke point in the financial system. And it tells us that the credibility of reserve management, the stability of bond markets, and the balance of global trade can be thrown into turmoil with a single tariff code adjustment. As this story continues, one truth is impossible to ignore. The fuse has been lit. The fight over gold in 2025 is not just about bullion. It is about the future of financial trust, the shape of global trade, and the willingness of nations to weaponize what was once thought untouchable. The outcome will leave scars on both sides, and the echoes will be heard for years to come. Gold, the ancient safe haven, has once again become the stage for modern power plays. And the question now is simple: who pays the price, and who walks away holding the real leverage?